I know this is a longer afternoon for some of you who have just been watching the press conference with the Fed chair. Kim and I are very pleased to be joined by two very distinguished guests and great friends. Before COVID, we all would get together and have a beer and have some snacks and watch these press conferences together and talk about what came out of them and talk about all things monetary, fiscal, macroeconomic. And so it's good to simulate just a little bit of those. And I miss Karl and Claudia and our conversations a great deal. So it's nice to be able to both see their faces and hear from them. Both of them have ridiculously long bios that we're not going to get into all sorts of awards and affiliations, but Karl is back at Bloomberg Opinion, and Claudia is also at Bloomberg Opinion, but also at the Washington Center for Equitable Growth. All right, I think here my guidelines for the conversation will be like, let's try to stay away from prediction and just get into reaction. And I guess, I'd love to hear off the top the things that are sticking out to you from either the framework review or today's press conference. Claudia, you want to kick us off?
Yeah, no, and first of all, Sam, thank you so much for getting us together. And I agree, like, these are more fun at the Mad Hatter than over Zoom. So I appreciate, seeing everybody's friendly face. Yeah, that's a big question, right? So what do we think about the framework review, the press conference? It's clear that the framework review is still a work in progress. So even when you listen to Jay Powell, it's not entirely clear what the FOMC is trying to do or how they think they're going to pull this off, right? So, but there is a conversation. He's definitely leading the conversation, as he should as Fed chair. But oh my gosh, like the Fed presidents are just all over the place, and you even saw it in the decision today. And I actually have no idea what the 1% even meant, right? So I'm looking forward to these statements and comments. So, but I think it's kind of natural, but frankly, I think it is a huge distraction from the crisis that the Federal Reserve needs to be doing more in. And I am absolutely tired of them punting to Congress. I'd love to have Jay Powell be the Senate leader right now, but he is not. And so I really don't care what he and the FOMC think about fiscal policy. Like, get creative, like go ask Congress for more authority. So those are my big reactions. So I'm sure Karl some other ones to throw in.
Yeah, I want to circle back to those, but Karl, what are your big takeaways?
Well, yes, I mean, I spent a bit of time most of this year focusing mostly on tax policy, fiscal policy types of stuff. So, I'm a little bit like out of the frame of mind. But I mean, from what I heard today, I thought was, what I've been wanting to hear for years. I mean, I think the biggest thing is that there's no liftoff until maximum employment. I mean, we never heard anything like that before, right? No liftoff until maximum employment. So interest rates are going to be zero, not until, we hit maximum employment. From an economics theory point of view, that's exactly what you want. And even beyond that, saying that, we're going to let inflation, overshoot for a while. I mean, they could probably be more specific about that. I don't know how long and how far. Is it 2% average over 10 years? I mean, that's what we were talking about, like, before I, kind of got my head completely in fiscal space, or is it just a vague average 2% over time?
Yeah.
I mean, specifically, I don't know. I mean, Claudia probably knows the exact answer.
Yeah,
right?
Well, but they don't even need to worry about this. Even by their own projections, we're not getting to 2 until 2023. We got a lot of time for them to figure out, is it like 2 or 5? I mean, this is really a decision point in 2025 at the earliest.
Well, right? according to if their forecasting is correct.
Yeah, but I mean, if you take, the Krugman analysis seriously, the Woodford analysis seriously, the whole point is to guarantee people that, way beyond when things get better. We don't know when things are going to get better, but whenever that is, we're still going to be pushing at zero. So you're going to have a period where you've got high profits and these low interest rates. Things are going to be great. And so you can start investing now knowing that that period is coming. If you don't know that's coming, it's always risky, right? Like even if you have access to credit, even if you have cash on your books, right? You might be worried that like later on you're going to need that cash, or later on you're not going to be able to meet those loans. Because don't worry, because we're not gonna even charge you anything until things are gangbusters. So go nuts. I mean, like I think that's like the core message that you want to send to people who would even be thinking about investing. I mean, that's my sense.
Yeah, no, but I think, and this is a little bit to Sam's, like their forecasts are right or wrong. I mean, to me, it feels like they're just sending us sunshine and puppy dogs with this. It's all going to be great, and we can win you over with your words. And I frankly think too much of DC has done this, trying to like talk away the virus, talk up the economy. At the end of the day, businesses and families need money, communities need money. I mean, I get what the Fed is trying to do, but it's like words aren't enough, and they're actually not very good at words. So like it could backfire.
What words would you prefer?
I think at this point they're leaning very heavily on their communication policy, and they do not have a good track record. And frankly, the American people ignore them because like what they say doesn't make any sense to people. I mean, why in the world do you want inflation? Like, hello, who wants to go to the grocery store and pay more, right? There is a reason, and I understand the reason that the Fed has this framework. I understand how we should read the framework review and be like, oh my gosh, this is so important. But I couldn't give this to my mom and explain to her why this is the Fed doing more. So I think they've got to like, if they really want to use the power of the words, they got to figure out a way to use words that are powerful. I'm happy to help. I'd love to work in public affairs.
Yeah. All right. So there's two different issues here. One is the sort of, let's call it framework and forward guidance, and then the other is what should they be doing right now. I'm sort of with Karl. Like I was in the weird position where everyone was very excited about the framework review, and there was a lot of headlines. Our friend Greg Ip referred to it as revolutionary, and I was like, I don't see how this is revolutionary. And I particularly saw a huge discrepancy in the speech Powell gave, which was all about full employment. I mean, he's been our full employment, spokesperson for going on 2.5 years now. Like that's his, he might as well be like singing the Employ America gospel. But there was a huge disconnect in my mind between that and then saying, and our framework is, average inflation targeting, which is like, oh, okay, it seems like it should be what symmetric inflation targeting was supposed to be. And I know there are differences, and I don't want to minimize them, but I was sort of like, if the project is full employment, how can it all ride on inflation being 1.8 instead of 2.6, right? If this is like the challenge of our time, how can we like make these distinctions where, well, we're going to deprioritize it when it's 2.6? So, but today's statement, and let me just read it once again here. I mean, the key line for me, the committee decided to keep the target range for the federal funds rate at 0 and expects it will be appropriate to maintain this target range until labor market conditions have reached levels consistent with the committee's assessment of maximum employment. And not or. Remember, Evans' threshold was or, right? Either. So this is like an upgrade on Evans in two ways. One is it's an and, not an or. And two, Evans was 6.5. The committee is already saying, longer run is 4.1. So we've just knocked 2.5 percentage points off of, from Evans to this, right? And obviously, they could wiggle out of this by redefining maximum employment, but this is a Fed chair and really a whole committee now who's seems to have gotten on board with like, actually, if we're going to redefine maximum employment, it's going to be, in ways that are more favorable to us, like, unemployment can still mask, huge gaps in labor force participation, et cetera. So I don't know. I mean, I'm inclined to think that's pretty powerful stuff, like the and the maximum employment. If they had stuck a 5.5 on there, I might not be as excited. But given what they've just done over the last year and sort of probing maximum employment, and even saying in 2019 when the unemployment rate was well below 4, we don't even feel like this is maximum employment. We're not even hot yet. That feels like a pretty strong update to the Evans thresholds. But Claudia, what are Karl and I missing? Are we?
Yeah, so I would love to tap both of your optimism and also David Beckworth. I tried to use his glass half full, 2/3 full to balance my shattered glass. But I think the issue, and this is having been at the Fed for over a decade until just last year, the staff and the committee always look at a whole range of labor market conditions, right? Like they do understand, and particularly as time went on, that full employment actually is a thing. Like Congress really meant it when they said you have 2 mandates. And so to me, they're just saying what they've already been doing. And we saw after the Great Recession, they consistently said, oh, we're at the bottom. We pulled all the people back in that can be back in. And consistently people were like, no. When it gets better and better, we can come in and that's good. So I understand the desire to have discretion. I do think that the Fed needs to create rules, or at least articulate them in a we're absolutely going to do this, and they can just be guardrails. When they hit 5.5% unemployment, they can keep going, right? And thinking may change. We are so far from 5% unemployment. I don't care about their projection for next year. That just, without more fiscal relief, that is not happening. So fine, it moves around, but they do a review every year, just update the number. It isn't that hard. And I'm just afraid they're just taking baby steps to get to a place I think you want them in terms of thinking about thinking about full employment. But I hope I'm wrong.
So it's
I think how it changes big for me, and I mean, this is a fundamental disagreement, I think, or a big market monitors thing, is that we don't even like the idea of trying to estimate full employment as a number at all. Right. And so this sort of takes us out of that. So we're going to get to full employment, and inflation is going to be hitting 2% before we lift off at all. And then we expect it to go higher. So that's as close as I think you could say, is that we will run the economy hot. Instead of trying to hit the target, we're going to go past the target. We're not even going to tap the brakes until we're crossing the line. Right. I think that's what you're,
and that really is a big change. So I will affirm that. I'm just afraid that tapping the brakes is they ought to be pushing on the accelerator right now. So the fact that we're spending all this time talking about whether you tap or don't tap the brakes when you're in a good place, but again, it is a big deal. So I do want to affirm what they're doing is important. I just don't think it's the most important thing to do right now.
So, but what else could they do, besides driving down interest rates, besides driving down the risk of higher interest rates later or something like that? What else do you think they could do?
Yeah, so they absolutely have to get out of this asset price stuff. I mean, they can keep doing it, but the idea that that's the accelerator is, I agree with you. They're people don't need lower interest rates, right? So I do think, and this came up today about the Main Street lending facility, the municipal lending facility, hundreds of billions of dollars were set aside by Congress. They told them to stand up the facility. They put aside money for losses. There's been a lot of tension. I frankly think the Fed could have pushed harder over Treasury, but whatever, there's a disagreement, there's a spat in the sandbox. So they need to go back to Congress and say, we need you to clarify, under the guidance you gave us, we're not getting the money out. And that was for me a disappointment at Jackson Hole. And again, today, the Fed won't go ask for more, and not in public. I mean, I hope to God they're doing it in private, because in public it could freak out markets. But just go ask Congress for that authority and get that money out. That's a first step. And I think there are bigger, take out the big guns kind of actions, the Fed, but they need congressional authority, but they're not even asking for it. They're pretending they can do it with, you said, tinkering around with interest rates and more asset stuff. And that's just that's not going to do it. So it might.
Yeah. I mean, I think, what they're saying is they have a cushion to, these losses instead of, the way I would have preferred it to be written is that we're going to keep going until we lose the money. I mean, so we're going to keep lending to more and more people until we burn through these losses, because if you're taking on any measure of risk, sometimes it's going to go bad. Sometimes you're going to get losses, and we're okay with that because we need to take some risk to get people out of the situation. So I think I would go with that. I mean, I definitely see how CARES was written. It doesn't say that. It basically says that this is sort of like a buffer. It does, and in fact, CBO scored it as ultimately not affecting the budget. So CBO expects to get all that money back. But like my preference would have been to say, yeah, no. I mean, lose it. Go ahead and lose it.
Yeah. Can we send you to Treasury? This is the thing, and the Fed and administration have been spoiled by, in the past, when the Fed is the conduit for the bailouts, or Congress does, or not even call them bailouts, they make money on them, right? And with with the middle-sized businesses and the municipalities that are getting hit by COVID, they are not going to make money on these. And so I think there's just this threshold that isn't what Congress intended, or at least that's my reading of the CARES Act. But it's okay to go back and let's make this better, right? But just continuing, anyway, so I'm hopeful that there's something going on in the background, but these programs were announced in April, and it is September.
Claudia, can I try to, is this a fair summary where, you hear me talk about Evans Rule, and this is an upgrade on Evans Rule, and you're like, that's fighting the last war. This is that might have been better. If we had done this, then it might be better than what we got, in say 2009 to 2015. But now we're in a totally different situation, and the Fed, incremental improvements on Evans Rule isn't going to get the job done when we need something bigger. I guess the Fed, is that fair?
Yeah, no, and I actually think if you went back and applied the Evans Rule, or you applied this average inflation targeting back after the Great Recession, I think the positive effects of that would be really small. Because we've been in a low interest rate environment, and they just, I don't know, I just don't think it would have, I think, hopefully gone in the right direction. But
All right, then let me ask you this, and Karl, I think will have interesting insight on this as well. And I saw you react on Twitter to Neil's piece today, which I will summarize, and maybe this is unfair, but I think I will summarize as, and this is, I think, a widespread sentiment, but it goes something like this. Because the Fed because the Fed is a relatively nimble institution, and because it acted forcefully, and because it put a floor under bad outcomes, so it didn't feel like the floor is falling out. Even though things are bad, it doesn't feel like, the whole bottom is collapsing, at least for a certain sector of important stakeholder sector of our economy. That they take away the pressure on Congress to go big. And, you can sort of see a little bit of that, like when Charlie Evans got asked in a press conference about municipal pricing, he sort of alluded to let's see whether Congress steps up and does state and local aid, which is, sort of kind of begs the question, are you not changing the terms because you want to put pressure? And I think we would all agree, grants are more useful to states and locality. And we've always said that, grants are more useful. But I saw you react on Twitter to that, and I think I am sympathetic to your point, and I sort of go back to the Kevin Warsh. I was very critical of Kevin Warsh back in 2010 when he said, basically he said in the transcripts, we shouldn't be doing QE2, punted to Congress. They should be doing structural reforms. We should basically hold back our ammo so that other people step up, which kind of feels like a little bit like hostage taking, right? It's but anyway. Claudia, what do you think? What do you think about all this?
Yeah, so this goes back to my point about I'm tired of listening to Fed officials opine on what Congress should do. Yeah. So one of the things, I left the Federal Reserve to go to Equitable Growth so that I could advise Congress, staff, and members on automatic stabilizers. So how to fight a recession, how to use fiscal policy. As a Fed staffer, you don't go to the Hill and tell them, hey, here's a good way to do your job. At this point, I have worked with over 30 Hill offices on both sides, and they know Grants are better than loans, but they also know that there's deficit spending and there are concerns. I frankly think Congress should be spending a lot more, trillions of dollars more, but I get it. Like, there are concerns about debt to GDP. Like, and I'm not an elected official, they are, but it does not take much to understand what has been happening in Congress after the CARES Act passed to know that there is no more money coming from Congress this year, right? Like, none. So, like, I can't believe the Fed isn't.
So then the Fed should just go wild. Should just go wild on the municipal lending and the Main Street lending, take losses,
Or just go do their work, right? Like, I mean, since May, you know what I mean? Like, I think in the beginning it was like, oh, this is really bold. Powell is talking about fiscal. Like, the Fed officials did not used to do that.
Yeah,
So times it was like,
this is the time.
Yeah. So it's like, that was a big thing, but like, we're months into that, and they need to be having a serious conversation with the public about what more they could do, as opposed to telling us what they can't do and what Congress can. Because I
don't think that's productive. I mean, what I would go to Congress and say, I mean, I wrote out back when I was working on some of this stuff, a whole framework that was built around this, sort of like a nominal income type framework. But they should go to Congress and essentially say, okay, what does this mean for you? Well, interest rates on treasuries are really tied to the federal funds rate. And we're telling you that those interest rates are going to be low until the economy is recovered. When the economy is recovered, tax revenues will go up, spending on, relief will go down. And so you can be clear that you're going to be able to borrow cheaply, at least until things are good. And so, feel okay about that. Feel okay that, we're holding down interest rates, until there comes time that you have more money. And when you have more money, then you can pay back the loan. I mean, that's essentially the message that Forward Guidance is supposed to communicate to businesses, and the theory is that, like, big businesses will understand, and that small businesses might not understand, but their loan officer will understand. He'll get it. But like Congress, you just tell them that directly. Like, look, you guys are worried about the cost of the debt, and that's a long run issue. But I can tell you that interest rates are going to be low. The immediate cost is going to be low specifically until you have more revenue and you have fewer expenditures on stabilizers. And so,
Yeah, and to your point, the municipal lending facility has a 3-year payback window. Like, why? Like, state and local governments that are getting hit hard, they are not going to have the money in 3 years, but like, make it a 5-year, 10-year, or to your point, tie it to an economic condition, right? When they have the revenue. Like, this is not that hard. But like, of course they're not taking it. And to your point too, there's a lot of, these lending programs, the decision of, do I take a loan, do I not take, like, they're really complex, right? And so we're missing the boat on helping people, and then we're gonna have a bigger mess. And then the Fed is going to have to, like, we're just gonna have to bring out a lot bigger tools that we don't need to if they just did their job. And that goes for all of DC. It's not just the Fed.
Karl, this is the shirt. This is the time to use the great fiscal power of the United States. I mean, part of me is like, if I'm trying to imagine Jay Powell on this call right now, like hearing you talk, Karl, and he'd be like, well, this is what I'm saying. Like, I'm already saying this, Karl. Like, I don't
know if they understand that particular point, right? I mean, I think what they hear is that he's saying that, like, we need more action, we need more stimulus, and they're thinking, well, I get you, but here's, this other problem, and so we have to balance these risks. We owe the taxpayer. This is the mentality, right? And they say, no, we actually have your back on that problem. As the thing.
I see. So you don't have to worry about borrowing costs go up for 5 years, whatever.
For 5 years, or not only that, until things get better.
Yeah.
So if you're worried that things will never get better, then I can tell you borrowing costs will never go up. So don't worry. Borrowing costs will only go up when things get better. If you're afraid that you'll spend a bunch of money and things will get better, then you won't have to pay anything. So don't worry about it.
You're better networked, obviously, on the Republican side than I am. My assumption is the reason we haven't had more fiscal is not only around deficit and debt concerns, Although I think those are potent regardless of what the Fed says, frankly. But I also think there's just huge disagreements about the things we're talking about. I mean, you could see it in the unemployment insurance debates. That was the most prominent, but the week after CARES passed, I was reading Heritage's stuff. I was listening to Mark Levin on talk radio. I mean, these people were bludgeoning the idea of doing blue state bailouts, just like we cannot do grants to California after they've wasted so much taxpayer money and, XYZ, sins of California. And so I guess, I don't know. I guess I'm sort of skeptical that would be enough to generate the spending. Although, maybe some hybrid is, some I don't know, some compromise around direct payments to people. But
those concerns. People do have disagreements or whatever, but those concerns can be addressed, right? So the what is it? Problem Solvers Caucus or whatever came out with a thing, and it had underlined many times in the state and local thing that documented expenses related to the COVID crisis is what you get money for, and that was to assuage people whose concern was that states were going to get a bunch of this money and use it on all sorts of problems that they'd incurred in the past, right? I think that would go a long way with people, right? What happened, I think, was there was a sense of urgency around CARES, and there was a lot of arm twisting, and people went for some things that they wouldn't naturally go for, like the $600 thing. There was a flip out where Lindsey Graham and some people were convinced that it was an error, they just couldn't believe that had been written, and other stuff, so other things like that. But the idea was, we're going to do this, we're going to hit it hard, and then the virus will be over and the economy will recover. So the virus wasn't over. The things seemed like they were getting worse. There were all sorts of disagreement about should we continue this? Is it open-ended? Is it going to last forever? Are we doing UBI now? Some of the people are, is that the thing? And so there was a mass freak out over that. And I think that just sort of broke things down, the sort of cohesiveness. And where I think actually the Trump administration has been good on getting people to is the more spending plus more tax cuts compromised or whatever. But in the confusion, you had a bunch of people retreat to the okay, none of either. So rejecting the payroll tax cut, rejecting other things I don't know what's happening. This is crazy. I'm being lied to by the administration. We're not going on with anything. So I think there was a sense of chaos, and I even felt it fall apart in, I guess, the first week of August, where we were talking to offices and we were here's, we would call it the sugar. Here's the sugar that's going to make this go down easy. No sugar.
Yeah.
All kinds of things that were pro-growth tax cuts, and no, we're not doing it. We're not doing it. And then and I think it was that kind of reaction. Plus, there became this surging fear of a repeat of the Tea Party experience. And so for people outside, I think the Republican Party don't realize how much of a threat that was to the Republican establishment. It almost completely took them out. And so they're terrified of this happening, of this happening again. And so so I guess the Democrats, it just looks like one version Republican, another version Republican. But if you were to relay it in Democratic terms, it would be this huge AOC search came in, and then they're afraid that oh my God, AOC is going to be Speaker of the House. That's what's going to happen. The population is going to freak out. They're going to elect all these Tea Partiers, and then we're just going to be completely locked up. So I think that's there's fear of that. So there's fear that if they can't go back to their voters and explain why this is going to work, that there's going to be a backlash. So it's kind of that. I think if things were, I don't know, if there was probably more leadership, to be honest, that could be calmed down. But but there's not, and things are breaking down because people are worried about what's going to happen. And then like, I really think, I don't want to get too much into personalities, but like you cannot overestimate the destructive power of Steve Moore. Like his insistence
we know all
on
about Steve
distracting
Moore.
the White House on just inane stuff that wasn't going to go anywhere in Congress really burned like time that people needed to like get something together. And as time went on, they started to freak more, and it's just like ratcheting levels of freaking. I think is what's going on. But I actually don't agree with Claudia that there's no chance. So like I think there is some chance. I think it's going to be hard. It's going to be really hard. But like something on the verge or something in the range of the problem solver stuff, I think you could get that through. You could get that through much of the Republican Senate if the Democrats would go for it too. They would need Democratic votes to get it to the Senate. But they could get like 20 Dems. They could let they could let Rand Paul and other people have a protest vote, and then get it through. But I don't know.
Yeah, I don't trust the process. I mean, I was told by someone who has a lot of experience in economic policy that, oh yeah, they're gonna pass the extend the 600, the unemployment benefit or something like that, but it's gonna pass at midnight on July 31st.
Yeah.
It didn't pass on midnight of July 31st. I actually told this person, I was like, excuse me, you told me in June. And then the week in August, I agree, that was like a total train wreck. I just, and they did so well in the CARES Act. Like I was shocked. I did not fall asleep until it passed the Senate because I'm like, oh my God, they don't even know what they're passing. This is so good. But I think, they came together in the crisis. Their whole thing was premised on an economy that was going to be better in the summer. Like you said, the virus gone. That was totally not the right forecast. I didn't think it was the right forecast in March. I mean, why not prepare for the worst? Why not tie it to the unemployment rate coming down? But like, it's just, and then it's an election year. Like if all this had happened in 2019 or 2021, maybe we'd have a shot. McConnell introduced $300 billion. The HEROES Act is $3 trillion. Like, oh my God, we're an order of magnitude. So maybe something will happen, but I just feel like some of the stuff that's going on, it's like throwing a hand grenade and creating more chaos, right? But hey, we pull rabbits out of hats. We need them to.
Well, I think people started to be lulled in thinking that McConnell was omnipotent, and like,
well,
that's not true.
Some people on Twitter, engendered this expectation, Karl.
No, he said early on, this is going to be a rough one, boys, and he has that like whatever Kentucky way. So when he's like, this is going to be a rough one, boys, I mean, it's going to suck, right? Like I don't know if I can do this one, and that's usually how it is. It's like if it's going to happen, it's like dead silence. I mean, I think that's what people were expecting. It's like dead silence right up until the moment he whips the last vote. But like anything like, ain't looking good, that means that we are in a bad position here. But yeah.
So we have 5 minutes left. I've already taken a lot of your time. You guys have already been very generous, and we've ignored all the great questions from our viewers, which maybe we'll come to some other time. The biggest theme I'm getting from the questions, Claudia, is could the Fed in any conceivable world move as fast as Claudia Sahm wants them to move? And what, like 3 sentences on what that would look like? Like what would today's press conference have looked like if Claudia was giving it as Fed chair, today?
So yes, they can move fast. They moved fast in March.
Yeah, they did.
Moved even faster in 2008. I can remember sitting glued to my computer, refreshing when Congress voted down a bailout package. And I thought, oh my God. And then like a day or two later, the Fed came out and was like, oh, by the way, we have these special emergency powers and we're going to do it anyway. Okay, so like, don't tell me that they can't be creative. I mean, it was all about blue sky thinking that. I want to know that there are blue sky memos going around the Fed, that the attorneys are working day and night to sniff out some other thing. And that's what I wanted to see at the press conference. I mean, I wasn't holding my breath for it, but like, they can do it. And they could have been working behind the scenes to make it happen. Like, again, they could need more authority, but they figured out a way in 2008 to do it. So like, get to it.
And if you could give them one new tool or one program tweak or one rule suspension or one, what's the key lever that will pack the most punch? You know, if they were going to do one thing, is it the penalty rate on the municipal program or?
So I agree with Karl. They've got to get in a place where those programs can go out where there is some possibility of not getting that money back on a short time frame.
Take losses.
So
take losses.
And you've got to, I think they should be targeted. And right now the rates on those loans is above market, right? And for some of these communities, like they need help so much. Congress is not giving them money. We can get loans pretty damn close to money, but it's got to be like lower interest rate, longer terms, and like help these municipalities and medium-sized businesses figure out how to get the loans, right? Like there's a lot that needs to be done, but it can be like they can do this.
Maybe we should do a letter or something. I watched a hearing at the very beginning of this crisis, and I remember Doug Holtz-Eakin. I might be totally butchering this, and I'm sorry to him if I am, but like Doug Holtz-Eakin was like, these programs have to take loss. Like everyone on the panel was like, these programs have to take losses. Karl, what's your last word? What do you want to leave the viewers with?
Oh yeah, I don't know. I mean, I was actually just mulling over Claudia's thing. So my very last thing is, I mean, people are burned by this, but they could bring back the subprime CDO, and then the way that's structured is like, people at different levels take different losses, and just have the Fed take the first losses. So like, we own the first 10% of losses on this. And so until that happens, the bank doesn't lose any money at all, right? So the bank makes a loan for whatever, $100 million, until 10 million is gone, they don't take the bank takes no loss whatsoever. Fed eats it all. If they did that, I mean, maybe subprime all over again. So I mean,
only Karl Smith would reach back to subprime.
But instead of like Lehman holding it, the Fed would hold it, and the Fed can't go bust. So
I love it. I love it. You guys are great.
See, there's blue sky.
There's blue sky. No, that is. I take your point. I take your point that in March we had the emergency meetings, and it was whatever it takes. And do we have the same whatever it takes spirit now? And I'm more optimistic about today's statement than I was about the framework review. There's a lot TBD. I miss you both. I can't wait to see you both again in person. You're so generous to join us, and we'll see you around.
Well, thanks so much. I appreciate it. Oh, and we should give a shout out to your biggest accomplishment of the week. Like there's going to be another vacancy on the board.
There's no accomplishment yet. No Fed. There's nothing official has happened on Fed nominations.
It's not moving fast.
It's good. All right.
Room for you on the board. So, all right. Thanks so much.
All right.
All right.
Bye.